When most people think of life insurance, they imagine a big payout that goes to their family after they're gone. But what if your insurance plan promised you regular money during your lifetime too? That's exactly what Moneyback insurance policies claim to offer. And today, I'm going to break down how they work, how they differ from term and ULIP plans, and whether they actually deliver on their promise or do they just look good on paper. Hello folks, I'm Shashank and you're watching Ditto Insurance. If you'd like a free consultation for your health or term insurance needs, then head to the link in the description, and without any spam or upselling, we will let you know which are the best plans that are available in the market suitable for you. Look, a money-back insurance policy is a savings-linked life insurance product. So, unlike a pure term plan that offers only death benefits, money-back plans give you periodic payouts during the policy term itself. These are called as survival benefits. So, for example, you might receive 20% of your sum assured every few years while the policy is active, and then at maturity, you get the remaining sum assured plus any applicable bonuses. And in case of policyholder's death during the term, the nominee still gets the full sum assured, regardless of how many payouts have already been made. Now, this might sound like the best of the both worlds, life cover and regular income, but let's take a step back, because let me tell you how this is really different from other life insurance products like ULIPs or term plans. See, ULIPs or unit-linked insurance plans are market-linked. Your returns fluctuate with the market and your premiums are split between investment and insurance. Term insurance that we basically work with at Ditto, on the other hand, is a pure protection-based plan. It gives you large life cover for a very low premium, but no survival or maturity benefits are there. A money-back plan falls somewhere in between. It offers basic insurance with guaranteed returns, but the returns are usually low, and the life cover is much smaller than term insurance. So you are getting a bit of both, but not the full value of either. Okay, let's talk about how the payouts are structured. Let's take an example of LIC's 20-year money-back plan as an example. The policy pays out 20% of the base sum assured at the end of 5th, 10th, and 15th year. Then in the 20th year, the maturity year, you get the remaining 40% along with any declared bonuses. Now, some insurers even offer the maturity amount as staggered payout over 5, 10, or 15 years, what they call as settlement option. But here's the catch. The interest rate for such staggered payout is usually quite low. LIC, for instance, currently offers just over 5% for this. So, unless you absolutely need structured cash flows, taking the money as a lump sum and investing it elsewhere could give you better returns. Now, if the policyholder unfortunately passes away during the policy term, the nominee receives the full sum assured, regardless of how many payouts have already been made. If the policyholder had chosen staggered payouts for death benefit, those would be passed on to nominee as well, again subject to minimum payout thresholds. Now, what happens if you miss a premium or want to exit the policy midway? Well, most money-back policies offer a grace period of 30 days for quarterly or annual payments and 15 days for monthly ones. If you still miss the deadline, the policy lapses, and unless you've paid at least 1 year's premium, you lose all benefits. If you've paid 1 year, the policy becomes a paid-up policy, which means the life cover and maturity value are reduced and no new bonuses are added. If you decide to surrender the policy after paying at least 2 years premiums, you will receive a surrender value, but this is usually much lower than the premiums that you've paid. Look, some money-back policies offer riders too, optional add-ons for extra protection. You can get accidental death benefit, a critical illness cover, a waiver of premium rider, and even a disability benefit. Now, but again, these riders come at extra cost and not all insurers offer the same features. Okay, now let's look at some actual numbers so you can do the math for yourself. Suppose a 30-year-old non-smoker buys a LIC 20-year money-back plan with 12.5 lakh rupees sum assured. They pay a premium of about 77,000 rupees per year for 15 years. Now, over time, they get 2 lakhs at the end of the 5th, 10th, and 15th years, and 11.6 lakh rupees at the end of the 20th year, including bonuses. Now, in total, that's 17.6 lakh rupees in benefits for a premium outgo of 11.4 lakhs. Now, let's compare that with HDFC Life's Click to Protect Supreme, a pure term insurance plan. For the same 20-year term and 15-year premium payment term, a 1 crore life cover would cost just around 15,000 a year, which is over 5 times cheaper. And while this plan doesn't give you anything back if you survive, it does give your family a 1 crore payout if something happens to you. So if protection is your goal, you're clearly better off with a pure term plan. Now, that brings us to the big question. Who should consider buying a money-back policy at all? Now, if you're someone who doesn't qualify for a term plan due to health issues or income constraints, this could be the second best option. Or if you're extremely risk averse and prefer guaranteed but modest returns over market linked ones, a money back plan could offer some peace of mind. But for everyone else, it's a product that sits in the middle ground, not ideal for protection and not ideal for wealth creation either. Now, IRDAI regulates these plans very carefully. Insurers must disclose what's guaranteed, what's not, and how benefits are paid. There are clear guidelines around bonuses, surrender value, and payouts. But from a financial perspective, these plans are still considered low yield and limited in flexibility. Our view at Ditto is simple: keep insurance and investment separate. If you want life cover, buy a term plan. If you want returns, invest in mutual funds, PPF, and even fixed deposits. And if you're ever confused about what to choose, just book a free call with our advisors. We've helped over 8 lakh Indians find the right coverage with zero spam and honest, unbiased advice. So, is money back insurance policy worth it? Well, in most cases, no. It gives you a little of everything, but not enough of anything. You're better off protecting your family through a pure term plan. Alright folks, that was it from this video, and I will see you in the next one. Until then, happy insurance hunting.